How do inflation expectation changes play into the GIP model, or is it based on current inflation CPI changes only? Do you guys look at expectations of inflation?
Yeah, well, inflation expectations are run pretty tight with headline inflation. So if you look at slide 15 one more time, you can see that, and can I draw on that one, guys? I think this is an important question to give people a quick teach-in on this. Because it's really a travesty that Wall Street, in particular CNBC and the Wall Street Journal, everything like that, they've never really taught the average high net worth person or the little guy that doesn't really have a lot of retirement income or savings for that matter. They haven't really taught them how to reallocate their assets to things like Treasuries. And I think that's a really sad thing. It's a sad story in America because it's a really easy thing to do. I mean, all you have to do is get the rate of change of inflation right, and you're going to get your asset allocation away from tips or inflation protection into Treasury bonds rate. So one way to think about this, which is really the only way to think about this, is if you look at the rate of change of inflation, which we're showing here, which peaked right up, let's see here, it peaked right here. Okay, see this period in time? This is Q3, again, peak cycle. So what happens is inflation goes like this. If you go back to 2015, people literally were talking about deflation because inflation was falling. So now inflation's rising, and bond yields are rising. And an increasing amount of people on Wall Street, including the Journal and the CNBCs, are talking about how interest rates are going to rise. See how that works? A certified idiot can tell you what happened looking backwards. But only maybe the village idiot continues to jump on the bandwagon right in here, telling you to short Treasuries. Okay, from here to here is called a rate of change peak and then slow down from here to here. Okay, right here. You've already taken out 100 basis points in inflation expectations just on the headline. And inflation expectations, you can look at that. I already showed you the chart of break-evens. You can look at it in terms of commodities. Look at that as a CRB index, which peaked and rolled in May. You can look at that in terms of markets that are reflecting upon the inflation components that they're along of. Oil went down 41% from October to December. 41. So that would be an adequate way to express falling or crashing inflation expectations. And that's really what happens. So next time this happens, and you may have to wait years for this to happen, and I mean that quite literally. You might have to wait years to get the cost basis that you could have had in Treasuries in here. Across the curve. They only come around once in a while. And this is another reason why people are like, hey man, spies, dude, you're wrong on spies. I'm not wrong on Treasuries, and that's the real thing that I own in my PA. 401k, RIA, long only. This is where all my money is. I have a hedged book. I got a trading book. I do all that fun stuff. But the most of my money is in those accounts, including my Hedgeye equity. And my Hedgeye equity also includes saying buy Treasuries when nobody wanted to. Okay, so I'm okay with telling people to do what nobody wants to do. Don't forget, we started this firm saying that the stock market was going to crash in 2008 and the economy was going to continue to slow, no matter what cowbell the Fed provided. And back then, if I would have known what I know now, I would have been much more aggressive buying Treasuries. And you learn, right? You learn. Every cycle you get better at this, hopefully.
Want more Hedgeye? Subscribe to Hedgeye Risk Manager, the holy grail of risk management investing tools. This deluxe suite of investing products includes ETF Pro, Investing Ideas, Market Edges, The Macro Show, Early Look, Risk Ranges, Real-Time Alerts, Plus, Macro Select, and our quarterly investment outlook. Try Hedgeye Risk Manager today. Now for the low price of $24.99 a year.